Hello and welcome to Bloomberg Quint. It's Friday and I bet you're saying, thank God it's Friday. Well, not only because we're looking at a weekend, but also because we're joined by a very special guest today. So this is someone that we know, this is someone we've watched for years, taken cues from for years. And if you're thinking big, if you're thinking long term, then you're in the right place because we are here in the Lambi race car expert, Ridham Desai, Managing Director of Morgan Stanley. Thanks, Ridham, and it's an absolute pleasure to have you.
Same here. Wonderful to be on the show.
That's awesome. So, Shraddha, you want to get off the map?
Yeah, we will. So, the latest Morgan Stanley report says the bull case for BSE Sensex is 36,500, bear case is 23,000, and the base case, which has a 50% probability for the Sensex, is 30,000. That's less than 5% upside from here on. Ridham, very often you've spoken about how the corporate earnings are at an inflection point. That's one. And second, the fact that India is trading at valuations which are close to peak levels but not at peak levels. So what makes you give a target which is just about 5% up from here?
So firstly, India is not trading at peak valuation, nowhere close. India is just trading above historical averages. If you use PE or price to book as a metric, on absolute basis. Where this trading close to peak is on a relative basis.
Okay.
Essentially because the EM multiples have come down. So, I mean, just to illustrate this point, in 2007, December, India was trading at twice the EM multiple. But then India was trading at 6 times book. The EM multiple was 3. Today, India is again trading at twice the EM multiple, but India itself is trading at 3 times book. So it's actually half the level of 07. But that's because the EM multiple has gone down to 1.5. India is still, trading back to those levels at 07. So if you look at the relative price to book chart, this is where we were trading at the end of 07, and then we know what happened in 08. So that's the clarification of that. The upside to any asset with a 12-month view or a 6-month view has to be seen in a relative context to what is happening in other parts of the world. Because really on a short-term basis, assets don't do their own thing. They perform, so over the long term, of course there will be a stock that will give you very generous return, and there will be another stock that will give you very poor return, then the index return will be somewhere in the middle, but there will be a large spread there. But in the near term, it's very rare to get that, especially on an index. So this index upside has to be seen in the context of what we are saying to say emerging markets as a whole. So our emerging market index target is a 10% downside. So the fact that India is a 5% upside will represent a much better return than what we expect for EM as an asset class. So India is still our largest or second largest overweight position in the EM portfolio. So generally speaking, we're bullish. That said, I think the market is getting a little bit stretched. We published yesterday evening that the factors that favor the market and that are against the market on a near-term basis seem to be balanced. So as a risk management strategy for those who do 6-month, 12-month stuff, and a lot of my institutional clients are concerned about those near-term calls, it is not a bad thing to take a little bit money off the table and wait for the market to come down. Now this is very different from what long-term investors should do because they should not bother about these things. But building a cash reserve is always a good strategy in any market because you always want to be in a position to take advantages of opportunities that come by your way. If you're fully invested all the time, then you never get that opportunity. But tactically, I think the market looks a little bit overheated and therefore is vulnerable to a correction. So you need to manage risk a bit more astutely. 6 months ago, it was the absolute opposite of today's situation, which is that share prices were oversold and you needed to back up the truck and buy stocks. Today, I think you need to take the truck out of the garage and just keep it parked. I mean, take it back into the garage and just keep it parked there, or at least start moving towards the garage.
Okay, you're seeming a little cautious now.
Well, actually, I had a follow-up question on that one. Should we gear ourselves, embrace ourselves be ready for, really high valuations eventually, given we are looking at a lot of liquidity, not just in India, but globally too?
No, so let's separate the India story from the global story.
Okay.
I think India is on a structural upward path.
Right.
The next 10-15 years are likely to be a golden period for India. So anybody who doesn't own equities will massively regret this in hindsight.
Right.
And the younger you are, the more equities you should have.
Yeah.
Okay, so if you're in your 20s, 100% or 90% of your portfolio should be equities. If you're in your 60s, then obviously that number will be lower.
Yeah.
Because you need cash more often, and in equities you don't want to be in a position as a forced seller.
Right, right.
So I think it's a golden period. If 2003 to 2008 was the mother of all bull markets, I call this the grandmother of all bull markets, and we're just at the beginning.
Right.
So we're really not seeing the movie as yet. It's happening right now. Of course, that doesn't mean that bull markets don't go through corrections, and sometimes they go through really vicious corrections.
Right.
I recall the one that happened in 2004 when markets fell 30% in 2 months.
Right.
And if you're in the middle of such a correction, it can get very unnerving. So, for retail investors, the best strategy is to just systematically invest money every month,
right,
and not worry about the index and not worry about stocks in specific. Institutional investors, of course, try to trade this a bit more actively,
right,
which is their job, which is their profession. So, again, there has to be a distinction here. So, when I say that you have to manage risk better, that is more an advisory to institutional investors rather than to retail investors who are not equipped necessarily to do that. And they should not even bother. They have a day job to do. This is not their day job. Institutional investors do this as a day job as well as I do. So the India story, I think, is looking very strong. The global story is not looking so clear. I think it's very muddy out there. This liquidity thing is not going to last forever. And it will end, I think, a bit more poorly than what is being priced into asset classes right now.
Okay.
And that will act as a headwind to India at various points in time.
Right.
Hard to time all these things, but we may be at such a moment right now where there is confusion about where monetary policy is heading. And at some point in time, some policy maker makes a mistake, and asset prices come down.
Right.
India will bear part of that correction, and then we'll move on. But I think we are in a secular bull market, and we're at the beginning of it. So you've got to take a 10-15 year view and be invested.
So we are at the beginning of what is going to be the mother of bull market. So picture me back is what
I don't have a better word, but if you have a better word, then I'll borrow it from you.
So that's what you're saying. Tell me which sectors will really lead the next leg of rally from here on. So I know financials have done well. We don't know what has really done well. What has done well, will that continue to do well, or do you see outperformance coming in from some other sectors? What will drive the next leg?
No, so the next leg may be down, so it is not going to be a rally.
That is near term.
Yeah. So no, the question is for which time frame then?
No, I'm talking from a 1 year, 2 year perspective.
So if you take a long-term view, then I think you need to be invested in India's consumer. He is the brightest spot in the world right now, without ambiguity. The Indian consumer is sitting on a very strong balance sheet. He's sitting on an inflection point in income. And the combination is quite powerful. So let me explain that. So today India's household debt to GDP is just 13%.
Right.
If you X out mortgage, which is the debt we take to buy houses, the remaining is only 2.5% of GDP.
Right.
For India's per capita income, that's the lowest in the world. This 2.5 can go to 25 in the next 10-15 years.
Yeah.
What it will do is, it will produce a surprise on the consumption side. Because ordinarily when we make a forecast on consumption, we plot the income and then we match consumption along the income.
Right.
But if you are leveraging your balance sheet, the consumption actually runs ahead of income. Because debt is nothing but borrowing from the future. So this current generation of Indians, I feel culturally, is set to borrow from its future. Mind you, my generation did not. My father's generation did not. Well, we'll come to that.
Okay, alright. Yeah.
Okay. One thing at a time.
Okay.
So my father's generation did not, I have not, which is why we are sitting on very low debt. But the current generation, I think, is not going to be averse to borrowing from its future.
Right.
Eventually it will all end in tears, but that's really far away. Okay. We're somewhere where the US was in the 70s. It took 40 years for America to end up in its current situation.
Yeah.
Which is also not so bad, because you lifted your quality of life and your living standard as much as you did by borrowing from the future, which is the cycle that India is likely to go through in the next 30-40 years. So I think the consumer will lead it. Financials therefore will be a beneficiary as well, because when households are growing their balance sheet, financials will benefit. So these two sectors are obvious. You can see that in the marketplace right now. There are some crazy bids out there for both these sectors.
Right.
So tactically, I think these sectors, look a little overdone, overcooked. So
Right.
there could be a correction, but you want to buy that correction if it happens, because structurally the story is very good. So these are the two sectors you want to back. I think in part, industrials could do well. It's a purely domestic sector. India, I think, will invest quite handsomely into infrastructure. This government is very focused about it. Already I'm sensing that next year, infrastructure spending as a percentage of GDP will hit 40%. We've done a lot of groundwork in the last 2 years, so infrastructure expenditure is going up quickly. So industrials will benefit. The other sectors which are globally oriented will not depend on Indian industry, like technology, like healthcare. So those I think are outside my focus list right now, because I think it depends on what happens globally. But from a tactical perspective, and we did that yesterday, we've got overweight tech.
Right.
Because it got smashed.
Right.
Okay.
Yeah.
So in the last 6 months, technology has borne the brunt of the sectoral adjustments that have happened.
Right.
Which is discretionary is up, financials are up, and tech is down.
Right.
So tactically, you may want to rotate. But structurally, I think we still want to be in discretionary consumption and financials.
So guys, we're going to come back to information technology, of course, and that is what I had my list as well. But I want to also ask you about how you pitch, consumer discretionaries versus staples. I believe that currently, at least in the near term, would be around over another year and a couple of years, you like discretionaries over staples.
So consumer staples, the challenge is the valuations.
Right.
Stocks are not cheap.
Yeah.
So a lot of that growth which is coming in the future is already priced in.
Right.
And while it may not matter if you're a really long-term investor, like a 20-year investor, it will matter if you look at it from a 2 to 3 year perspective.
Okay. And follow-up question on that one. We haven't really seen much in the QSR space right now, or media. We're looking at a lot of these companies struggling when it comes to earnings. How are you viewing the quick service restaurant industry and the media sector, particularly specifically?
Within the consumer discretion.
Within the consumer
So
discretion.
keeping aside some of the business dynamics and the challenges that arise because of the disruptions that are happening there,
Right.
in technology, right? So assuming that they are managed by the respective companies. From a sectoral perspective, I would be bullish on these sectors.
Right.
For the simple reason is that when I am leveraging my balance sheet, I am borrowing to the future. Right. So I'll use that money to buy a house, to furnish it, to
Right.
buy a car. That spares me income to buy other things.
Right.
So
right.
consumption down the curve actually starts improving.
Okay.
So you will find more Indians visiting restaurants,
Right.
consuming media, and other discretionary stuff, which will gain share in total consumption.
Right.
There's another way of looking at it, is that if you look back, say 20 years ago, 65% of our consumption basket was food.
Right.
Because we were really poor as a nation.
Right.
Now as we get richer, the share of food will go down. So it will release a lot of income to do other things. Like think about entertainment. Today it is 1% of our consumption.
Right.
So can it go to 2%? I mean, that's not a very tall ask.
Yeah, that's-
If the share of spending in entertainment doubles in the next 10 years, and nominal income growth is at 11% or 10%, you're talking about 20% growth in that sector. So I think we'll see a lot of subsectors do that because they will gain share in the consumption pie.
Right.
You spoke about income growth being at an inflection point. I'm not sure if we are there. A lot of people are complaining, but I do hope that is true. Now again,
So no, you're talking about household income? Well, the job creation has actually gone up in the services sector. I think the error that people make is they evaluate this from the manufacturing sector point of view. But manufacturing sector is less than 25% of India's economy. 60% plus of India's economy is services.
Right.
And you just look around in your office and count the number of people you've hired in the last 6 months, and then you know what I'm talking about.
we are new. That doesn't count.
Anybody who's in the services sector is hiring.
Yeah.
True, but I don't think salary levels are at their best right now. They're not.
When they get to their best, it will be over. Right? So we have a long way to go for that.
I really hope so. And true, what you said is that majority of our GDP, the biggest share comes from services sector. Again, a larger part of which is IT, which is really facing some pressure, and that's the reason I really made the statement. Okay, again, from your report, you mentioned about 15 stocks that could double over the 3-year period. I just realized that majority of them are domestic plays, and of course the list does not include any commodity names except for HPCL. Now, when it comes to oil marketing companies in general, I just want to understand, is there a structural story, or is it just a call that you've taken on crude oil?
No, I think the structural story is playing out, which is that hitherto these companies were not in control of their earnings. Their earnings were determined by the government. So these companies were therefore, they came to know about their earnings after the quarter ended. Imagine you run a business where you're not in charge of your earnings. The third party decides how much money you will make, and that is at the end of the quarter, depending on the government's subsidy and fiscal balance. So that catharsis has happened there, which is that these companies are now in charge of their earnings, and it is not fully priced in because the market is still adjusting to that. Okay, it's one of the inefficiencies in the marketplace that there's still skepticism that the government will come back and take charge of this again, if oil prices go up a lot or something of that happens. So the market is still very reluctantly valuing these companies on the basis of their earnings, because they are still not confident, it's still not confident that the earnings are there for real. So that's the story there.
So you think there is a scope for subsidies to come back into play in case the crude oil really runs up?
I'm actually saying that they won't come back. Yeah. So I think we're done with the oil subsidies. Okay? And one of the smartest things that this government has done is that when oil prices were falling, they increased taxes. Okay? So they did not let that oil price fall go into the consumer's hand. And a lot of people criticize the government for that, saying that they should not have interfered in the free market process. But I disagree with that criticism. I'll tell you why. At that moment when oil prices were falling, real rates in India were negative. Right. Had you given that largesse to consumers, they would have taken that money and imported Chinese goods. Right. We would have not seen this macro adjustment that happened in India. Instead, the government took it as taxes and built infrastructure. Right. So for the nation and for the citizens of this country, it was a much better outcome. So now we can say that when it was happening at that time, it was not clear to people, but now we can say that. So it's happened. And they use part of the money to consolidate that risk, which in turn has helped out bring down inflation. So I think in hindsight, this was a very good economic decision by the government, one of the lesser appreciated things in their policy delivery.
Okay, so coming back to IT, the markets, at least right now, are reluctant to touch any of even the bigger IT companies. But you're saying that you recommend increasing allocation in the information
technically, I think that's the moment to buy stocks when people don't like them. Yeah. Because when everybody likes everything, then there's very little upside left. So I go wrong very often. So I have to say that this afternoon I was on my London sales call, and they said, you're making a tactical call, it's so hard to call bottoms and tops. I said, yeah, I know. The better thing for you to do is to toss a coin and then you decide. And the toss of a coin generally beats my record, so keep that in mind. But yeah, I think when a sector is beaten down and hated, it's usually a better time to buy. 80-20, Pareto rule works. I may be wrong if this is one of those 20% occasions when it doesn't work.
Okay. You've said very often that envy and boredom are two emotions that a trader is faced with. Which are the 5 stocks that you bought?
Investors.
Investor. Okay.
Traders are only faced with greed and fear.
Greed and fear.
Yeah. So here's a good example in tech. Everybody is fearful. There's a structural collapse coming in profits and incomes, and therefore all the stocks are sold down. And there is greed in consumer and financial needs. Kind of a mini greed, not a all-out greed. In contrast, investors face envy and boredom. So there's an itchiness to act, like almost on a daily basis. So you've got to prevent that. And there's envy because the guy next door has made more money than you, and that prompts you to actually do something. And the lesser you do on your portfolio, the more money you make. Yes, if you act too often, then you actually lose money. See, all the money that investors in the world have made has come from where? It's come from all the money that traders lose.
Right, yeah.
So the more you trade, the more you lose, and investors make that money.
Yeah.
Okay, so you're saying you haven't really gone and bought anything out of either envy or
No, of course not. I make a lot of mistakes on a daily basis. Don't even imagine that I don't get bored and I don't get envious.
Okay, then tell me, is there any stock? Oh, okay, if you can't talk about stocks, is there any theme that
I'm a
you
very
really-
fallible human being. I make mistakes all the time, and I think the only thing is that I try to learn and prevent them from happening again. But they happen again also.
But you think we need more awareness when it comes to psychology as well as behavioral finance? Do you think we need more awareness in our markets, or you think people are always attuned to their emotions, they just choose to ignore it?
No, you're going into a subject which is challenging to cover in this show.
All right, fair enough. No, so we can be a little more brief.
But I think, I think investors should be more aware of. We should all be aware. I can tell that to myself also.
Yeah.
About not getting carried away and not getting frozen in the moment and not getting envious and not getting bored. Four emotions. If we can deal with those emotions, then I think we'll probably end up being more successful.
Okay. I have a follow-up question here. Any stock or any theme that you think you should have bought but you missed out on?
Lots of them.
Lots of them.
God, I miss money making opportunities all the time. I'm atrocious.
You want to describe, maybe not take the names, but you want to describe maybe one or two of the most recent ones?
Yeah, we should have closed out our underweight in materials there. We just looked at, I was looking at it and it was the tech moment. Materials wasn't a tech moment 8-9 months ago. Everything was sloshed and it looked people were so bearish and I just looked and didn't do anything. So we make these mistakes all the time.
No, I think a lot of people must have lost out on materials because that rally came from just nowhere.
Well, so actually, here I was reading about Elon Musk and how he practices transfer learning. And for our viewers, what it means is that he uses the learnings of one sphere and applies it to another. So my question then to you is do you use your learnings from other facets of life and apply to equity research?
So Charlie Munger calls it multidisciplinary approach.
Right.
I'm a Munger fan.
Okay. Yeah.
Lesser of a Musk fan. So, but it's the same thing.
Yeah.
All successful people have a multidisciplinary approach in life. So we should all know a little bit about physics, history, psychology, mathematics, and we'll get better at whatever we do in life.
So what are the areas that you draw from?
If you think that your job is different from knowing a bit of math, revisit that thesis.
Okay, so what are the areas that
take some, ask your firm to pay you for some math classes. It'll help you.
Yeah. No, so I want to know about the areas that you draw from life, of course beyond equity. Would it be music, would it be sports? I know that you're big into fitness.
Everything. Think about maths, think about you mean to say
outside.
Yeah, so there is an element of discipline which comes from pursuing fitness, which I think is very crucial in the stock markets.
Yeah.
So there's certainly some area of application. They are transferable from one place to another place. That is, you can be a disciplined investor and then use it to be a disciplined person in terms of your eating and fitness habits, and vice versa. So maybe that's one thing you could think about.
You must be really liking Talwarkar's value fitness as a stock. You believe in fitness.
See, I tell you, there was this thing that that's something that people talk about, is that when you buy a business, if you are using that product, then it's very easy to understand it and buy. And that's a highly misunderstood concept. So just because I do something, that doesn't mean that the business is good, right? I think it has to be evaluated separately, and then what people don't pay attention to is the price.
Right.
It's a very important ingredient.
Right.
If you overpay for a business, you can go through years of zero returns. Doesn't mean you will not come out good, but you will really be, in for the long run. In the long run, it overcomes the disadvantage, but for 5 years or 7 years, you can easily see no returns. And then you have to be that patient.
Right.
Again, not a very philosophical question, but stock markets really teach everybody a lesson. What has been yours? Do you have any what was like the toughest lesson that you probably learned?
That's a tough question. I've learned a lot of lessons.
Okay.
No one particular thing that I can think of immediately.
Okay. You can move on to the next one.
Yeah, actually, so I want to also address skill and luck. And if you consider some of the best bets, or at least a recent best bet, how much has skill played a part of it, and how much has luck been a part of it, and how much importance would you give luck overall in general?
So, Michael Movasin, you know of him, right? He writes a lot about this subject. So he delves into this to explain the differentiation. So, think about a carpenter.
Right.
How do you judge how much luck is required in a particular role, right? I mean, how much luck is involved in your job or my job?
Yeah.
So think about a job in which you can fail deliberately. So think about a carpenter who has to make a table. It's
Right.
very easy for him to fail deliberately. You just cut one leg short. Table comes
Right.
down.
Yeah.
It's fail. So 100% skill. Because he's in complete control of the failure of his job.
Right.
Think about Sachin Tendulkar batting. Right? He wants to get out on the next ball. He can try. He can try to lob a catch. He can try to get run out, but it's not necessary that he will get out.
Absolutely, yes.
I mean, he's trying to get run out. He's standing in the middle of the pitch, but the fielder throws the ball and crosses the boundary.
Right. Yeah. Yeah.
So 30-70. 30% luck, 70% skill. It's still a pretty high proportion of skill. Now think about stock markets, and you can do this experiment in your office and then
Yeah,
report back
yeah.
to me. Ask people here to that they have to lose money on 10 stocks for the next 6 months. Lose money.
Yeah. Yeah.
You'll be surprised that 90% of the people who are trying to lose money will end up making money in those stocks.
Money. Yeah. Yeah.
So you can't lose deliberately. This is a very large role of luck.
Right.
Particularly if you're looking at it from a short-term perspective. If you disintermediate time and look at it from a long-term perspective, then you can take the luck factor out of it, or you can reduce its effect. But if you're doing 6 months and 12 month stuff, you are generally governed by luck because you can't deliberately fail.
Fair enough. Yeah. Yeah. Yeah.
You have any other questions?
No, I guess my list is done. Yeah.
So it's a Friday today, Ridham, of course, and I don't know, what are your plans for the weekend? What I'm trying to ask is, what do you like doing in your free time when you're not working?
So plans for the weekend, I'm reading this absolutely outstanding book, Yuval Harari, Overdears. Okay, I'm done 2/3. A Brief History of Tomorrow.
I was just telling Shraddha about that.
I'll finish that book.
Yeah.
Pink, I'll watch that movie.
Okay.
And then maybe, and then of course I'll run.
Yeah, that's what you like doing. Okay, thank you so much for joining us, Ridham and Quint. It was an insightful and a fun session. And as for you guys, we will be back on next Friday with the next edition. Have a good weekend.